to DLS tutorials. Yes, today I want us to look at advanced console. In financial reporting, we have our basic knowledge or we learn something about group accounts where control will begin at once. The parent will just buy the subsidiary and the parent will have control over the subsidiary. But in corporate reporting or strategic business reporting, this is not always the case. Or in reality, this might not always be the case. It can happen that the parent will gain control over the subsidiary in stages. What do I mean by stages? The parent can buy first 10%, next 20%, and the parent will come and buy what 60%, making a total of what 70%. This will be done on different dates. So this is what we call acquisition or control being gained in what step, which we call step what acquisition. It can also happen that the parent will buy 50% first, and come and buy 10%, later come and buy what 10%. You can see that in these situations, control is not gained until the parent bought the 40. In this situation, control was gained at the first acquisition, but the parent is still buying what part of the subsidiary shares. So if you say about step acquisition, we have only two situations. It can be from non-control to control, where the parent was not having a control, the parent was just carrying the investment at maybe at in accordance with financial instruments or using equity method as an associate or any of them. So the parent is not having control. The parent was carrying this thing or having percentage control less than 10% or 20% or anything. So the parent will be buying in stages until the parent acquire more than 50% or equal to 50% of the subsidiary. That is where we say control is gained. Control can be gained in so many ways. It can happen that the parent may have only 20% control, but the parent will appoint more of the board members or more of the the management of the entity, or the parent will have higher voting rights. You can also say the parent is having control over the entity. It can happen that the parent is the among all the shareholders. The remaining 80% will be split among so many people. So the parent is having a higher percentage, which is 20%. You can also say control is there. But if you come to this situation, we are saying that we are assuming that control will be 50% or more than 50. But we are saying that this can be done in stages. Or the parent can gain control and try to buy more shares again. So we are going to look at how they account for this. We are going to look at from non-control to control and also from control to what? To control. How do we treat this? We are going to look at that one. From non-control to control, consolidation is done at the date that control is gained. Calculation for goodwill, everything about consolidation is done at the date, from the date that the parent gained control over the subsidiary. But in this case, if the parent is having less than 50% in the account, how will the parent account for this? The parent can be using either equity method or carrying this in accordance with financial instruments. So the parent will be having that investment over there. So at the date that the parent gained control over the subsidiary, how will these issues be done? Assuming the parent has only 15%, the parent has 15% at a cost of 100,000. But 1 year later or 2 years later, the parent bought additional 45% at a cost of 400,000. At the cost of 400,000. So the parent will now be having 60% control. The question is the initial investment. How is the parent carrying the initial investment? Is it using equity method or financial instrument or just at cost? If it is at cost, then at the day that control is gained, there will be a fair value of the initial investment. So assuming the initial investment, the fair value at this date is now 150,000. What is happening? You can see that it has increased by 50,000. Therefore, we did recognize the initial investment and assume that we are buying a new investment. So the assumption is that assume that you are selling this and you are rebuying it. So if you are selling it, then you will sell it at 150 and still buy it at 150. Therefore, there will you will make a gain of 50,000. This gain, the treatment depends on how the parent is carrying it. If the parent is carrying this at cost, then this gain will be sent to retain what? Earnings. Retain earnings or P&L account if you're preparing P&L account. Then the parent is carrying the initial investment at fair value. So assuming at the date of this one, the parent has 120,000 in respect of this in each financial statement. So you can see that the parent will sell this for 150, but the cost is now what? 120. And this will give us a gain of 30,000. So this will be the gain that will go to P&L accounts, and this will be the gain that will go to retain earnings. But this is equity instrument. This is equity instrument. If it should be a debt instrument, we reclassify the 20,000, which is a gain to retain earnings. But for equity instruments, first line, financial instruments say that we don't reclassify. Even if we dispose it, it will still be in the other reserve or other components of equity to be there. We don't reclassify that one. No. But if it should be debt instruments, we reclassify this one, we send it to back to retain earning because the the instrument has been sold, so we realize the profit. But for this one, we don't read like that. So the standard is saying that whenever control is gained, revalue your initial investments. Take the fair value. Assume that you sold it and you re-bought it. So if the value of that instrument that you have, if it is 100,000, now the fair value is now 150,000. You are making a gain of 50,000. Send that gain to what? Return earnings. If it is 120 and you sold it for 150, the fair value is now 150. Send it to what? Return earnings. That is all we do under this one. But consolidation and calculation of goodwill start from the date that control is what? Gained. So if this is done on 1st January 2020, and this was January 2018, we can't start consolidating from this date. We start from this date. We calculate goodwill and everything from this date. The calculation of goodwill and everything is not different from what you learn in FR. This is all about from non-control to what? To control. What will be about from control to control? The treatment of the new acquisition or additional shares bought is different from non-control. So assuming the parent bought 50 first, 50 first, or let's assume 60 first, the parent January 2020, the parent has already gained control. So consolidation will start from this date and calculation of goodwill will start from this date. But on January 2022, the parent bought additional what? 15. This will be for parents in NCI from this date to be 40%. So the parent cannot go anywhere and buy the 50%. So the parent is buying 50% for the NCI. So from this day, the NCI will be 25. So the meaning is that the NCI is selling 50% of its shares to the parent, and the parent will give them money. How do we account for this? The NCI is going to sell 15% to this one. So at the date of the acquisition of the additional shares, we have to know the value of the NCI. We have to know the value of the NCI. If you know the value of the NCI, then that value represents what? 40%. So assuming at the date of the new acquisition, NCI is now 400 million, which is equivalent to 40%. We are buying 15% of this one. So our new acquisition now will be 15 over 40 times 400 million. And this will give us 150 million. So this will give us 150 million. So we bought 150 million from what? We bought 150 million from the SCA. So from this date, the SCA will be only 25%. But what if we pay, because we are going to give money to the NCI, we pay the NCI 160. We are paying more than this. So what happens? What happens? The standard says that do not recognize expense or profit on the acquisition, on the subsequent acquisition. So when there is any difference, send it to other components of what? Equity. So what is the difference? You can see that we bought 150, we pay 160. In this case, we should have said that we pay more, so this will be an expense. So So we said explain to retain earnings, but the standard said no. Send it to other components of what? Equity. Assuming we pay 140, you still send a 10 to other component of what? Equity. So at the date of the additional acquisition of shares, find the value of the NCI at that date. Then you prorata it. The percentage of the NCI is equivalent to the value of the NCI at that date. Then just find the percentage of the one that you have what? Acquired. So if you have acquired that one, you pay some money for it. You pay money for it. And the NCI will give you the share. Find the difference. If there's any difference, send it to other components of equity. Don't say you are making a gain or you are making a loss. You send it to retain earnings. No. That is how it works. But if you, how will you know the value of the NCI at the date of the new acquisition? You take the NCI at acquisition. The only thing that will cause a difference between that will cause the difference in the NCI is the post acquisition profit. So look for the post acquisition profit. Find the NCI share of it. So assuming at the date of the 60%, NCI was 300 million. So at acquisition, NCI was 300 million. But post acquisition profit was post acquisition profit was 200 million. So the NCI share will be 40% times 200 million. Then you get that figure there. Okay, this will give us 80 million. Then we now can add the 80 million to this one. So we have 380. This will be the NCI at acquisition. Then we find the 15% of this one, which is 50 over 40 times 380. That is how we calculate it. Then we compare that figure with the figure that we are going to get over here. We compare it with our purchase consideration, the value that the money that we pay for it. So that is it. So if you want to know the double entry, we are paying cash. We are paying what? We are paying cash. We debit cash. Then the NCI will take that value. Then the difference will go to other components of what? Equity. You have to go and reduce the NCI value by the amount that you got from them. That is it. Okay, so we are going to look at the treatment of step acquisition issues in statement of financial position and also in statement of profit and loss accounts. So let's take the statement of financial position first. Statement of financial position. So the first thing that you need to do is you have to ask yourself, when was the additional shares acquired? When was the additional shares acquired? We are talking about from control to control. So if the reporting period for the entity is December, January to December, and the parent was having 70% shares, the parent was having 70, NCI, parent will be NCI will be 30%. So assuming the additional shares was acquired on January, July 1, July 1, what will happen? It means that the post-acquisition share of profits, the NCI will take January to June at a rate of what? 30%. So if the profit is 100 for the year, we divide it by 2, 50. The first year, NCI will take 30% of the 50. But let's assume that you bought additional one 10% on July 1. So from July to December, the value of the NCN now will be what? 20%. So the share of the another 6 months, which is July to December, NCN will take only 20% times 50. Whilst the parent will take January to June, the parent will take 70% times 50, but from July to December, the parent will now take what? 80% times what? 50. Because from these dates, the parent acquired additional 10%, which will now become what? 80%. This is how we do it if you are sharing the post-acquisition profit. The same way, if you are dealing with statement of profit or loss, if you are dealing with statement of profit or loss, you have to know the dates that additional shares was acquired. So if the statement of profit or loss, the profit for the year, the profit for the subsidiary was 200 million. The profit for the subsidiary was 200 million. And the acquisition was done on July. The reporting year is January to December. Then we have to come and divide this one because this was acquired on July. That is 6 months. So the subsidiary the NCL was having, the parent was having 70. NCL was having what? 30. So NCL was contributing 30% to the profit from January to July. So therefore, this will give us what? 100. So if you are looking at the share of the NCL profit in the statement of profit or loss account, it will be like this. Profit attributable to NCL will be 30% times the 100 million plus they are buying 10, the parent is buying 10%. So this will now be 20% times 100 million. So the first 6 months, the NCA will take 30. The last 6 months, the NCA has now reduced to 20. So the NCA will take what? 20. So the total profit will be 30 plus 20. The NCA will take 50 million. That is how we account for step acquisition, both in statement of financial position and in statement of profit or loss accounts.